Good morning and welcome to our third video IFRS and Corporate Reporting webinar for 2026. Thank you for joining us. Today we are continuing our 2026 video IFRS and Corporate Reporting journey through IFRS 18, Presentation and Disclosure in Financial Statements. However, as always, before we dive into IFRS 18, let's cover off some housekeeping matters first. For those of new to the BDO IFRS and Corporate Reporting webinar, my name is Dean Ardern. I'm one of the partners in the IFRS and Corporate Reporting team at BDO. I'm located in the Melbourne office of BDO. I work with a range of for-profit and not-for-profit entities on a broad range of accounting and financial reporting matters. As always, we acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respect to their elders, past, present, and extend that respect to all Aboriginal and Torres Strait Islanders people joining us today. I'm presenting this webinar from Melbourne, or NAM, the traditional lands of the Wurundjeri and the Boon Wurrung peoples who are part of the Kulin Nation. This picture on this slide is of the Wheelie Wally Creek. It's actually a billabong in the Wheelie Wally Creek in the East Pilbara in Western Australia. Wheelie Wally Creek is traditional lands of the Nyapali and the Banji Mart peoples of the Pilbara. As I mentioned in previous webinars this year, apart from our traditional 30th of June and 31st of December financial and sustainability reporting updates, we have actually dedicated the remainder of the webinars this year to IFRS 18. So if you haven't already signed up for all of the webinars this year, good time to lock in those dates and times in your calendar. Now, with regards to sustainability reporting, we also have a full program this year. And I've mentioned before, notwithstanding Group 1 entities with 31st of December annual reporting dates would currently be literally up to their necks in sustainability reporting as I speak. The Group 2 entities must first prepare their first financial sustainability reports for financial years beginning on or after 1st of July 2026. So if you're a Group 2 entity, now is really the ideal time to join our sustainability webinar series. This month, Aletta Boshoff, along with, I think, Ramona Amos from our Brisbane office, is going to explain AASB S2 from the perspective of its role as a policy document embodying climate science. I mentioned in previous webinars, BDO Global has just updated its IFRS 18 in practice publication, so it's now available via the BDO Global website. The updated version has benefited a lot from input from the BDO network, thinking around IFRS 18 and how it might impact different types of entities. We also publish quite extensively in our Corporate Reporting Insights e-newsletter that's published every month that you can also become subscribed to through the BDO website. We also publish extensively on IFRS 18, have done and will continue to, and probably in a lot of respects, a lot of the material that we cover today and other webinars that we do on this series, you'll find supporting information in those articles in the Corporate Reporting and Insight publication. Now, flagged it in January and February webinars. Now I can actually confirm registrations are open for our IFRS 18 masterclasses. They are scheduled for Friday, the 27th of March. So that's the last Friday of this month on the topic of transitioning your profit or loss to IFRS 18. We've also locked in Friday, the 29th of May for the masterclass on transitioning your balance sheet and cash flow statement to IFRS 18. And we've locked in Friday, the 31st of July for transitioning your management defined performance measures. If you're an existing BDO client, please let us know. We're offering a price and or attendee number discount to those existing BDO clients. We've also incorporated a volume discount in the form of a lower cost per masterclass for those enrolled in more than one masterclass. We're conscious that some attendees might be interested in one or two of the masterclasses, whereas some might be keen to attend all three. Important to note that each of the masterclasses stands on its own. So if you just wanted to attend, say, number 2 and number 3, and not attending the first masterclass, that won't disadvantage you in any way. As noted in this slide, we'll be working through some real examples of entities transitioning to IFRS 18. We find useful practical examples makes the principles and requirements much more real and understandable. So that's why we're using actual examples. Subject to demand, we are likely to rerun masterclasses 1 and 2 later in the year for those who can't attend any of the upcoming scheduled masterclasses. So if you can't attend them, don't worry, we probably will have something, we'll announce something later in the year to accommodate you. Today's topics have been prepared to provide you with an introduction to how to apply IFRS 18 to an entity that doesn't have a specified main business activity. We're actually going to cover a lot of ground today, and I'm actually going to move pretty quickly through the material because there is quite a few areas to cover, and I wanted to use some practical examples to demonstrate some aspects of the application of IFRS 18. So there's quite a bit of material in today's webinar. Some of the slides, if you've attended previous webinars, you probably recognise the slides, so hopefully that'll help you move through them relatively quickly. But I am going to crack along today just to ensure that we can get through in a timely fashion the material that we have. Unfortunately, it's really hard to cut down on the material. IFRS 18 is quite extensive, and the more you get into it, the more you realise there's actually there to cover. So without further ado, let's really push into it. I'll do a little quick IFRS 18 recap. So just covering off sort of the key things that I've covered in the last two webinars that are relevant to today. IFRS 18, it introduces three entirely new categories of income and expense items, and that is investing, financing, and operating. And it retains two existing categories, they are income taxes and discontinued operations. Now, under IFRS 18, entities will be required to classify all items of income and expense into one of these five categories for the purpose of presenting their profit and loss statements under that standard. Now, I've discussed in previous webinars, but the purpose of classifying income and expense items into one of these five categories is not to provide a subtotal for each. Rather, IFRS 18 adds two new defined subtotals, neither of which are actually directly related to any of the individual categories, or in nomenclature terms, they're not related. The purpose of the categories is to guide what's included and excluded from the mandatory subtotals. Now, if I work my way across the slide from left to right, and I just want to highlight a couple of things there. Investing category includes income and expenses related to certain, that is, specified assets. This should immediately put you on notice that not all the income and expense items arising from assets are included in this category, so possibly some judgment required in applying IFRS 18 here. You move across to the financing category, again, income and expense items relating to certain liabilities, not all liabilities. This slide goes on to clarify that classification depends on whether the liability arises from transactions that involve only raising of finance and liabilities that do not involve only the provision of finance. So possibly some more judgment required there in applying IFRS 18. And the operating category, it's effectively the residual category. And I quite like that category. I've mentioned before, I like the idea that operating is the residual, because often it is really hard to determine what the ordinary operating activities of entities are, if they've got multiple, if they've possibly got multiple different activities, or if they're startups and they're looking at ways of trying to financially kick themselves off. The last two categories, income taxes and discontinued operations, I'm guessing everyone on the webinar today probably would be familiar with these two categories, so I'm not going to go into a lot of explanation on them, except maybe to say IFRS 18 incorporates the requirements in IAS 12 and IFRS 5 on separate disclosure of income and tax expense and profit or loss from discontinued operations onto the face of the profit and loss statement. So it's very, it's accommodating in that respect. So those are new they're not new line items, but it's to remind you that in terms of the classification of those things, it's only those items of expense and income that fall into those categories that would necessarily be classified there. And when I say fall into the category, I mean fall within the scope of IAS 12 or IFRS 5. The purpose, I mentioned before, that the purpose of classifying income and expense items into one of the five categories is it's not to provide a subtotal for each. So IFRS 18 adds two new defined subtotals to the subtotals that were previously required under IAS 1. And neither of these new subtotals directly relate to any of the individual categories in name terms, that is. So this slide's a simple example of the end result. After all the items of income and expense have been appropriately classified in accordance with IFRS 18, you can see the specified subtotals that IFRS 18 can be calculated for. So for example, the subtotal operating profit, it's the sum of all the items of income and expense classified in the operating category. Profit before financing and income taxes, so that includes the operating profit plus specified income and expense items arising from assets and so on as you move down the P&L statement. So how can we understand the relationship between the five income and expense categories and all the mandatory subtotals under IFRS 18, including these new ones? I've tried to do this in this slide. So what I've tried to do here is tried to give you sort of a summary of how sort of the standard works at a really conceptual level. So if we work our way from the slide from left to right, I start out, I've got my income and expense items that I have to start classifying. I apply the new classification requirements, and there are some policy options in there as well. So I might apply those too, if they're applicable. And then I get my income and expense items variously categorized into operating, investing, financing, income taxes, and discontinued operations. And when I've done that, then I can then look at those collections of incomes and expense items and position them relative to those subtotals. So operating profit subtotal, the operating profit before income, before profit before financing income taxes, profit before financing does, but the profit before income taxes, continuing operations, and so on. So it helps to guide where they're put in terms of those subtotals. I suppose the key thing there too to note is that IFRS 18 then doesn't go actually further. So it doesn't actually then say, well, within operating, for example, how do you want to present your items? Now IFRS 18 does have specify certain items that have to be also presented if material, but it doesn't necessarily then specify how within the various categories or within those various subtotals, various line items are actually presented and what they're described as. And that's consistent with IS1. We always had that flexibility to be able to determine how within the categories we might present something, but we need to sort of consider how it would be in the context now of the new IFRS 18 requirements. So IFRS 18 is sort of like IS1 in the sense that it's not prescriptive at the really sort of at the granular level, but it is prescriptive at the subtotal level. Lastly, I just wanted to cover off. I sort of talked about this particular issue effectively last week in the context of specified main business activities, but it's still relevant in this context. So just want to remind you that when we say apply an accounting standard, so when we say apply IFRS 18 to an entity, it typically means we interpret and apply that standard only to the extent it's relevant based on the transaction and events to which the entity is a party to. So that's normally how we use the word apply, and that's how we normally think about it in the context of standards. So we might say, look, I've applied the investment property standard, but I don't have any investment property, so I haven't accounted for any investment property under it. So I've applied it to the extent that it's relevant to me. And the way that structuring, the way that sort of wording works, it's a conscious decision by the ISB, because if you write standards to only apply to an entity that has specific features, you end up running the risk that you're going to have different accounting for the same or similar transactions across entities. Therefore, accounting under IFRS doesn't normally change as a consequence of an entity level assessment, because IFRS is written to apply to transaction and events, not to entities. But in the case of IFRS 18, it might be that you will find that as you move up through a corporate group and applying IFRS 18 at various levels, you might get different presentations, again, subject possibly to the existence of a specified main business activity, but also subject to what they have in their balance sheet and the profit and loss statement. So what is it that the entity does? What's their business activity? That can impact how they apply IFRS 18 and therefore lead to scenarios where maybe, in using just this diagram here, you might find that maybe sub A's profit and loss statement looks a little bit different from intermediate parents and the ultimate parents and maybe the groups as well. And that's because the requirements can apply differently at different levels. And that's probably a really important part of the IFRS 18 considerations. Now, before we go too deep, a quick word on the logic and sequence of today's presentation. So, as discussed, IFRS 18 actually defines investing and financing activities positively, in the sense that if an item of income or expense meets the criteria to be classified as an investing or financing activity, it's actually classified as such. So it'll be classified in investing or financing. But under IFRS 18, operating is actually defined negatively, in the sense it's everything that's not investing or financing or income taxes or discontinued operations. So it's everything that's not classified. It's the residual bucket that everything goes into. I've mentioned before, I like this approach. It can be difficult to apply. If you apply the operating category as a positive category, that can be challenging in some situations because entities don't always have an obvious operating activity. So I actually quite like it from that perspective. But it's important to remember that it is a bucket. So if something isn't positively applied in that context, if it's not positively identified as financing, investing, income taxes, or discontinued operations, then effectively it becomes a part of operating, and then we have to deal with it in that context. I think what I'm trying to say is my long-winded way of saying, I think I'm going to start with investing and financing activities first, because they're positively defined. And so you can, if you can apply IFRS 18 correctly by identifying correctly investing and financing activities and hoping that income taxes and discontinued operations are relatively self-identifying, then hopefully you're going to get your operating categories correct as well. It's only because they're the residual. So this is sort of how I've structured the presentation today, just based on what we positively define and then moving to what we negatively define. So where do the income and expenses classified as investing activities live under IFRS 18? If we start with those investing activities, we are starting with all those income and expense items that appear below the operating profit subtotal, specifically summarised in the profit before financing and income taxes subtotal, and included in all subtotals, therefore, below that. And this is what's hopefully this slide's evident to you. But you can see that there isn't necessarily a clear category called, investing activities. I mean, entities have the ability to make certain disclosures or add lines under IFRS 18 as they do under IS 1. But in this case, we're just working from the way the IFRS, we're using a generic model here in the way that IFRS 18 applies to these types of entities just broadly. So you can see where it sort of sits. This is where we're focusing on for a couple of more slides here. I think a word of warning, this is where the complexity actually starts. Items of income or expense are typically classifiable into investing based on the 3 criteria in the blue boxes in this slide. Now, that's their nature, whether the item's specified, and whether the entity has a specified business activity. Now, I put in the title of today's webinar, I'm not covering main specified business activities today. I did discuss them a little bit last webinar, and the reason there was a conscious decision for that, because the requirements applicable to specifying main business activities add another level of complexity to understanding IFRS 18. And I think if you understand the general requirements, then it's much easier to understand the specific requirements for specified main business activities. But without having that good grounding in the general application of IFRS 18, it can be quite challenging to apply IFRS 18 to entities with specified main business activities. So I decided to leave them out from today, and we'll come back to them. I promise I will come back to them. But I think I just want to focus really entirely on just the general requirements applicable to entities that don't have a specified main business activity. So I've coloured that last blue box a little bit lighter to highlight the fact that it's not going to be a key focus of today's presentation. As this slide really alludes to, the new classification requirements and the policy options, if applicable, determine whether an income or expense item falls into the investing category, and if not, then it has to be assessed or understood which of the other available categories does the item of income and expense fall into. And that's probably what I'm trying to get to, is just really now we are focusing on nature of income and expense and whether the income or expense is specified in IFRS 18. They're the 2 key criteria in terms of application of the investing category. Now, I've used this slide before. I think it actually summarises the key requirements applicable to income and expense items arising from investing activities quite well. So I'm going to keep using it until someone tells me otherwise. But if you work your way across the top, the slide, you can see there are 3 categories of specified assets. There's investments in associates, joint ventures, and unconsolidated subsidiaries. There's cash and cash equivalents. And there's other assets if they generate a return individually and largely independently of the entity's other resources. So they're the key specified assets that you're looking for if you're trying to understand whether and what I've got in my investing category classification. Now, each of these specified assets for investing category classification, so it's necessary but not sufficient condition for any income or expense item classified as arising from investing activities to be generated by one of the 3 classes of assets. Now, if I said that another way, there's probably an income and expense items generated by all 3 classes of assets, all 3 of those specified class of assets, which don't make their way into the investing category. And so if we work our way down the slide, looking at those specified income and expenses, so we're just focusing now on, say, investments in associates, joint ventures, and subsidiaries. So income generated by the assets could include interest, dividend, rental income. For other specified income and expenses, income and expenses arising from the issue and subsequent measurement, including, so, derecognition. So with some particular investment assets, it might be depreciation, might be impairment losses and reversals, or fair value gains and losses if they're carried at fair value, so like investment property. And lastly, the last group of specified income and expenses are incremental expenses directly attributable to the acquisition and disposal of the assets. So including transaction costs on financial assets at fair value through P&L, noting that they're not capitalised to the carrying amount of the asset, they're recognised in P&L, and also costs to sell assets such as broker commission. Now with that last category, the incremental expenses, I think the key part to take away from that is that not all income and expense items related to some of those specified assets will actually make it into the investing category. And I mentioned there, say, transaction costs on financial assets at fair value. If an entity holds shares in a listed companies and they're carried at fair value, then typically the broker fees occurred in acquiring these shares would be recognised in profit and loss, because the fair value through P&L classification would be considered incremental and directly attributable to the acquisition of the asset. But the fees paid to the investment advisors to, say, review and make recommendations on the entity's mix of shares in listed companies, they'd be probably classified as operating activities, because these costs are not incremental or directly attributable to the acquisition of the assets. So there's a few levels there which you need to sort of be conscious of the fact that, okay, I'm looking for particular types of assets, and then I'm looking for particular types of expenses and income items coming from those assets. And what doesn't fall into that second category has to go somewhere else. Now, the ISB actually considered but rejected alternative approaches, such as classifying all directly attributable expenses in the investing category, as this approach was seen as too complex and costly for an entity to apply. So you can imagine, often we might have employees that are doing work around investments, and whether or not, if those employees are not entirely dedicated to that activity, that their time is maybe spread, then actually trying to work out the cost of those employees and how much is attributable to the investment activities can be challenging. So as a consequence of that, you'll find that the ISB decided, look, it's better if we have one rule that applies to everyone across the board. It's probably a harsh rule, but it ensures that there's a consistency across the disclosures that entities have. I think to help demonstrate these distinctions, I think might be useful, a couple of examples I alluded to that I was going to have here. So start with the investing category. Let's have an example. So on the 1st of July 2025, Entity A acquired 25% of the outstanding shares in and significant influence over Entity B. For the annual reporting period ending 30th of June 26, Entity A accounted for its investment in Entity B using the equity method under IAS 28. Now, during that 25-26 reporting period, Entity B reported an operating profit after tax of $250,000. It revalued its property, plant, and equipment by $40,000 and reported a corresponding increase in the asset revaluation reserve. Entity A loaned $100,000 to Entity B, and as at the end of the reporting period, Entity B had failed to make all the repayments to Entity A in respect of the loan. Accordingly, Entity A had recognised a $5,000 expected credit loss in respect of the loan. And as a consequence of legal proceedings commencing against Entity B, Entity A actually recognised, separately from the expected credit losses above, an impairment loss in respect of the investment in Entity B of 20 grand. So they're the key transactions that have occurred. Let's think about classifying them between investing and other categories. So we step through first those income and expense items that arise from the equity account investment that are classified in the equity investing category. So we've got the share of the profit or loss of the associates accounted for using the equity method. So that's, again, income from that investment. The expected credit loss of $5,000 in respect to the intercompany loan. Now, that's not necessarily because it's linked to the investment. That's what the reason for that is that it's actually arising from an asset that generates returns independently of others. So the loan is considered to generate returns independently, and therefore it's going to be treated as a part of investing activities. And the last one there, the impairment loss, that's on the investment. So that would obviously also go into the investing category. Now we look at some of the others. So where do they fall? In terms of income and expenses attributable to the equity account investments that we classified into another category, we've got the interest expense, if there was any, on any loans used to finance the acquisition of the investment in B. So again, it's that idea that the ISB sort of said, look, there might be a loan there might be interest expense, but is it directly attributable? It may be difficult to determine, especially if they've borrowed money for multiple things and used some of the borrowings to buy the investment in the equity accounted investment. Any employee costs incurred to manage the investment in Entity A. And foreign exchange differences relating to, say, the borrowings in translating items to the entity's functional currency. So you can see the specified income and expense items, they're included in the investment category. Those that are not specified are excluded, so they probably have to go to another category. So in some cases it might be operating, in some cases it might be financing. And lastly, the income and expense attributable to the equity account investment not classifiable. The revaluation is not an income and expense item. It'll be going straight to equity, and so it'll be picked up by Entity A through its equity, so it doesn't actually affect the P&L. So I threw it in there really just to sort of, it's a furphy, just to make sure that you're sort of thinking about it. Let's look at another investing category example, Entity C. Now, entities are part of a large, and this is a complicated one because I tried to make it simple, but it became complicated very quickly. So hopefully it's not too complicated, but I do want to demonstrate a couple of things in this example. So Entity C is a part of a large corporate group that operates group treasury arrangements. Now, under these arrangements, Entity C has its own bank account. It commences each reporting period with a minimum cash balance based on its budget for the following 12 months. Cash flows arising from all transactions involving Entity C go through its bank account, so its individual bank account. At the end of the reporting period, any excess cash is swept from Entity C's bank account to the group's bank account, or else Entity C's transferred sufficient cash to meet its budget for the following 12 months. And all movements of cash between Entity A's and the group's bank account are accounted for separately by Entity C as an intercompany balance. So it's an unusual arrangement, but not unusual in sort of group companies. Sometimes you see the sort of the group shared finance function. So let's have a think about the items of expense and income that will be classified. So Entity C recognises a number of income and expense items in respect to its bank account, so including monthly interest income on the average positive balance over the period, fixed monthly account keeping fees. It also recognises penalty fees in the event that the bank account goes into a negative balance or overdraft. And it might also recognise monthly interest expense on the average negative overdraft balance over that period. So there's a couple of different expense items and income items that could pop up in respect to this bank account. Now, when we're thinking about where we classify each one of those things, for the purpose of applying IFRS 18, Entity C would classify monthly interest income on the average positive balance over the period in investing category. So we've already identified cash and cash equivalents as a specified asset and interest on that as a specified income item. So we recognise that in investing category. We classify fixed monthly account keeping fees, again, in the investing category. So they're just costs associated with the cash and cash equivalents. Now it starts to get interesting. We'd probably need to give further consideration to whether the penalty fees in the event that the bank account goes into a negative balance or overdraft and the monthly interest expense on the average negative balance over the period are classifiable in investing, or maybe they're in financing or operating. There's currently limited guidance in IFRS 18, and there's been some discussions I'm aware of that people are sort of considering what would happen if I've got a bank account that goes from positive to negative, and then what would happen with those expenses and income items arising from the bank account being in negative. So do we look at the bank account as a liability, or do we look at the bank account as an asset? Now, there's been also some discussion about whether you apply the undue cost and effort sort of approach, and you say, well, if you could identify, split them between investing and financing on the basis that the bank is also providing you loans, then maybe you do that. But there is actually no real specific guidance in IFRS 18. So this is a kind of area that we would expect to see that certainly, unless there's a clear indication by the ISB around this, going forward, by the time entities are applying IFRS 18, this is an area that you'd expect to see subject to an accounting policy paper. And we'd also assess whether the intercompany balance, now if that's a positive one from the entity's perspective, meets the criteria for classification as cash and cash equivalents in IS7. Now, it's a bit of it's not a furphy, it's an actual thing that arises. So imagine that they have got possibly a standing ability to request cash, in the sense that if cash has been swept out of their bank account at the end of the year, there might be a surplus of cash that's been swept out, and maybe in this case, the subsidiary or entity C has the ability to go back to the group and say, I'd like some more cash now. If that balance actually meets the definition of cash and cash equivalents, then you're going to have to think about, is there any income or expenses attributed to that balance? So do you attribute interest income to that balance on the basis that it's actually like a cash account, but not actually in a bank? So simple scenarios can give rise to some interesting thoughts and outcomes that you sort of need to be aware of, and particularly when it comes to classifying these things, because I find that if an account goes from positive to negative, that could create problems about classification of is it an asset or a liability, or also whether or not you need to split items between categories. So does a category contain an item contain multiple features which you have to then split and allocate income and expenses across, and therefore put them across different categories within P&L? They're probably the two chief challenges in applying IFRS 18. Now we'll look at the third one. Example 3: entity owns a building that it rents out to earn rental income. The building is classified by the entity as an investment property in accordance with the relevant requirements in IS 40. The following income and expense items arise from the investment property and they're classified in the investing category. So you've got rental income, depreciation if it's carried at cost, you've got fair value remeasurements if it's carried at fair value, you have incremental costs occurred to sell the investment, and you might have expected credit losses on the rent receivables because the rent, again, they're not necessarily related to they're related to the investment property, but they are recognised as an asset that can generate returns independently of other assets. So we've identified all of those things that we typically see with an investment property that would go into investing category. What about other things? So there's a range of other expenses and income that could possibly are related to the investment property, but won't be classified in the investment property. In the investment, it won't be classified as an investor activity. So as a consequence, you need to think about how your P&L might look, given that you've got this maybe mismatch between the income being in one section of the P&L and you've got a whole lot of expenses possibly in another part of the P&L. And how maybe how do you articulate those things? How do you aggregate them? How do you present them in a way that perhaps enables users to make the comparison? And the kinds of income and expenses we would expect to appear in the operating category, particularly the operating category, are things like cleaning and maintenance, gas and electricity bills, council rates, interest expense on loans, that'll appear probably in the financing category. Employee costs, generally in the operating, employee costs incurred in managing the investment property, again, probably in the operating category. Foreign exchange differences related to the borrowings of the investment property. Now that in itself, and I'll come back to that, but that may in fact be somewhere else. It certainly won't be probably in investing, but it's likely that it's going to be in financing. And gains and losses on foreign exchange contracts to mitigate the loan interest and principal payments. Again, subject to how that's being managed, it might appear in financing or in operating. And I'll come back to that point. The derivatives gains and losses are actually one of the areas that you've got to sort of separately look at and apply. So giving you a sense of how things sort of pan out in terms of the investing category, this is just a decision making. I think I've used this decision tree before. It's a good little decision tree in terms of understanding what are the assets I've got, are they specified? What are the income and expense items, are they specified? And where they go. And it's sourced from our BDO publication, our global publication. I mentioned in the overview that I'm going to give some takeaways. I've broken them down into sort of the separate areas, but they're very similar, I suppose, in terms of the kinds of things you'd have to think about. So when you and I think, as a practical first step, identifying investing category is probably the good place to start. There is, and I haven't put it in the slide, but I think that there's an underlying assumption in the first two steps there that I think I'm going to have to call out. So if you've been listening to this at the same time as thinking about how you're going to apply these requirements to your specific circumstances, particularly the accounting system that you're currently using, you might have picked up on this, and this is the assumption that your current chart of accounts gives you visibility to all of the income and expense items that you're going to have to separately identify and classify to investing activities separately from the other categories under IFRS 18. So if I was actually to look back at the example, say, of Entity A's classification of the various items associated with the equity account investments, if all of your expected credit losses on loans were captured in a single account that includes expected credit losses on, say, trade receivables, you potentially need to be able to isolate the credit losses on the loan to the associate from the credit losses on the trade receivables, because the loan credit losses will be going to, in this case, the investment category, whereas the credit losses on the trade receivables are likely to go to the operating category. Similarly, if all your impairments were captured by a single account that includes all other impairments, such as to property, plant, and equipment, you're going to need to be able to isolate the impairments of the associate from all other impairments, because, for example, an impairment to a PP&E item will be appearing in operating as opposed to investing. So really, subject to the capabilities of your system to isolate, say, specified income expense items, either you'd need to be able to either classify the individual transactions within an account, or else set up new accounts to actually classify similar items that will be classified similarly under IFRS 18. So if your accounting system can do this, and so as a first step, your system can actually make that, you've made those adjustments, or it is actually set up in a way that allows you to do it, then you'd start at the top of this slide by identifying all the specified assets for the investing category. You'd identify all the income expense items linked to these specified assets. Then you would distinguish the specified income expense items from the other items. So the other items that would go to another category other than investing. You would possibly, now this is for the purpose of maybe preparing your financials in a way that enables you to distinguish all of these line items and send them to the right parts of your P&L. You tag or maybe reclassify specified income and expense accounts to investing category, and presumably maybe depending on how your system works, maybe the other items then fall out to operating category. But last but not absolutely the least at all, formally documenting what you've done, particularly any assumptions, analyses, or policy decisions. So a good one would be the one I just spoke about, the idea of the if you've got a bank account that regularly goes into overdraft, how are you dealing with the expenses related to the overdraft component? So that's the key takeaways from the investment categories. Let's move to the financing category. So where does it sit? It sits just there below the investing category effectively. So interest expense on borrowings and lease liabilities, that's just one line item. There's multiple, there could be multiple in there, but then that feeds into the profit before income taxes. So it's almost the last line before your income taxes and discontinued operations. So it's sort of segregated out to ensure that sort of users are able to identify what's the financing component and how how's the money that what are the actual financing costs that the entity is incurring to run the business as it is. So I think I've used this slide before, but I suppose the thing I like about this slide is that it really highlights the fact that when an accounting standard distinguishes between items, the purpose is typically to facilitate different accounting requirements to be applied to different categories of items. And so this is the same with IFRS 18. So IFRS 18 makes a distinction between liabilities that arise from transactions that involve only the raising of finance, and we typically call those type 1 liabilities, from those that are classified as liabilities that arise from transactions that do not involve only the raising of finance, which we normally call tier 2, type 2. But there are some exceptions there, and I'll sort of touch on some of the exceptions, but as you can see from the slide there, some of the exceptions really just relate to those entities that are applying IFRS 17 and are therefore providing insurance contracts. If we look at sort of some of the features of that, the liabilities that arise from transactions involving raising of finance, it really is ones where there's not a service component involved. We are literally raising money, using that money for our own purposes, and then ultimately either going to pay that money back or we're going to satisfy it in some other way. So we might issue shares or do something else to satisfy that loan, but typically it's going to be classified as a financial instrument, and it's typically going to involve us having to repay in cash to basically extinguish that liability. So it's very much, there's nothing else involved. There's no services, no one's providing us in addition to financing anything else. It's very much related to just simply paying for financing that allows us to run the business. So let's have a look at an example. So example 1. At the start of year 1, entity D issued $100,000 of debentures with 3-year terms. Fixed annual interest rate of payable of 10%, payable in arrears over the term of the debentures. Now, at the start of year 1, entity D incurred $20,000 in incremental transaction costs to issue the debentures. They also incurred $15,000 of costs directly attributable but not incremental to the issue of the debentures. So let's say the $15,000 cost was a broker went out and identified 5 different loans that they could possibly get, and they paid the broker for that work, and then they went and negotiated directly with the lender at that stage. So the $15,000 wasn't really, it didn't arise directly as a consequence of issuing the debenture. It just arose as a consequence of trying to find somebody that they could sell the debentures to. Now, at the start of year 2, entity D agrees with the holders of the debentures to modify the terms to increase the fixed annual interest rate to 12% to align the market rates for the remainder of the term of the instrument. So noting that it started out as a fixed interest, and it's now a fixed interest of 10%, and now it's moved to 12%. And the debentures remained outstanding till the end of year 3, at which time the initial balance and the outstanding interest was paid. Now, let's look at the different. So this definitely looks like, and let's assume for the sake of this example, this is a liability arising from a transaction that involves only the raising of finance. So all they're doing is they're getting money in, they'll be using the money to run the business, and eventually at some point in time, 3 years later, they're going to have to actually repay it. So the following income and expense items arising from the debentures are classified in the financing category. The effective, so not the coupon, but the effective interest rate or effective interest expense for years 1, 2, and 3. So noting that the 20K incremental costs are actually included in the initial amount of the debenture liability, so they're an incremental expense related to raising the debt, and the gain or loss on remeasurement of the amortized cost of debentures. Okay, so what I've done is, and actually I'll skip to that and just clarify there too, that obviously the 15K we mentioned before, because it's not incremental, it's actually going to be treated as an expense, and it's probably going to be classified as operating because it's not related to, it's not directly related to the raising of the finance. It's related but not incremental. Now, what I've done is I've actually put this into, the reason I made it a practical example is so I can actually do this, which is actually give you a bit of a calculation to show you how the journal entries work and maybe how the numbers work and give you a sense of what goes where. So the top left-hand corner there, I've just done the initial, present value calc, and I've shown how that the repayments and interest unwind over the 3 years. So, they initially get $100,000, they pay $10,000 interest every year for 3 years. That's the expectation on day one. Okay, so when we work it out, we go, okay, so the opening balance is 100,000 because we're assuming, it's probably an assumption I haven't put in there, but let's assume that the interest rate they're paying on the loan is at market. So as a consequence, we recognise the incremental cost, the 20,000, as a reduction in the carrying amount of the debentures, and therefore we underlined the debt over the 3 years based on that fact. So we move down. If you're looking down the general journal, you can see the initial journal entry there. They've recognised the debentures and the cash. The second one, finance expenses, that's going to go to P&L. That's going to go to P&L as operating because it's unrelated to the entity. It's not a specified income or expense item for the purpose of financing category. The next journal entry down there, interest expense, I've just plucked that straight out of that the top table there, 15,525, and so it's going to accrue to the debentures, and then 10 grand is paid. That reduces the carrying amount of the debentures, and that's the end of the journal entries for year one. Now, if I move into year, in this case, year two, I think it was year two, there's a modification of the arrangement. So if you look at and it's under it's the second number under the heading opening. So at the start of year two, the carrying amount of the liability was 85,525. However, when I modify, and I'm using the same, again, assumption was that it's a non-substantial change it's non-substantial modification in the arrangement. So under paragraph 3.3.2 of AASB 9, I've just said I'm going to use the same effective interest rate. So I'm using the 19% again. If I discount the new cash flows at the old effective interest rate, I get a new opening balance of 88,603. So the difference between those two things is the 3,077 you see there in the middle of the journal entries. Now I've put an asterisk against that because in your journal entries, like in your chart of accounts, you might describe that as interest expense, or you might describe it as something else. It might be finance costs, or it might be, you might say a gain or loss on modification of debt arrangements. It's lots of different ways of describing it. Obviously, the important thing is that it is actually a specified income or expense item in this case, and so therefore you need to include it as a part of the financing activities line items. And so therefore I've highlighted in red to identify that. I've also asterisked to just go, you need to be aware that you might have a different name for it in your accounts. Or you might just treat it as interest expense. And then I just unwind the liability as per that second table there, down to zero at the end of year three. So pretty straightforward, but there is probably a couple of things in there that if you don't have visibility to those particular items, or perhaps you don't calculate them directly, I can imagine an entity might literally just go from end of year to end of year and work out the carrying amount of the liabilities at the start and the end of the year, and then just sort of reconcile within that. And some of those things might be interest, but they might not recognise them as such. They might be recognised as other costs for whatever reason, again, subject to materiality. So the visibility is really important because what IFRS 18 is doing is asking you to break down some components of movements and actually put them in different parts of your P&L. So we move to liabilities that arise from transactions that don't involve just the raising of finance. I've used this and I've shared this slide before. It's come straight out of our BDO publication, our global publication. And I think the key part is to distinguish this from the previous group of liabilities. It's pretty clear when you look down that left-hand column, you can see that there is some other aspect. So there's some financing feature, but there's also another aspect to it. So for example, if I looked at lease liabilities, there is a finance aspect to lease liabilities, but someone was also giving me services in the form of access to an asset. And similarly for defined benefit pension liabilities or any long-term employee liabilities under IAS 19, someone is giving me services, and in addition to that, I'm financing their long-term benefits. So as a consequence, there's a combination of things. So let's have a look at an example to sort of break that down. Example 2, start of the year, year 1, entity E anticipate will have to most likely required to make a $50,000 payment and make good expenses in 3 years when its current property lease ends. At the start of year 1, entity E determines the time value of money with respect to the make good provision is material, so discounts the payments at a rate that reflects the time value of money and the risk specific to the liability, but excluding the risks for which the future cash flow estimates have been adjusted. So imagine that the 50 grand at the top there reflects the best estimate of the costs. According to the discount rate, the start of the year 1 is 15%. Now at the start of year 2, discount rate increases to 18%. And then at the start of year 3, the estimated cash flow increases to $60,000. So that's your best estimate of your cash flows, whereas the discount rate decreases to 16%. Now this is not usual for a make good provision. They usually don't move around by this much, but I wanted to show this to just sort of give you a sense of how you have to break down these calculations to be able to then classify the individual components under IFRS 18. So we look at the individual items. So the items of income and expense that are arising from the provision that are going to be classified to the financing category are, so the interest expense for the years 1, 2, and 3, due to the unwinding of the liability. The gain on the, you might call it interest income, but it's effectively again a remeasurement of the provision arising from the increase in the discount rate in year 2, and the loss in the interest expense arising from the decrease in discount rate in year 3. So you have to be able to actually carve all of those things out. You probably don't have to carve them out from each other, but you've certainly got to carve them out from other components of the movement in the provision, which is effectively that re-estimate of the cash flow movements. And so you've got to be able to move that interest income gain or loss out of whatever line item that it might be currently sitting in. And again, I can imagine entities would look at things like provisions and just simply restate them year by year based on best estimates. So they would be winding up things like remeasurements of cash flows and interest rate movements into the one line item. And as a consequence, they wouldn't necessarily be able to, based on past practice, be able to carve out the interest from the movement in the underlying cash flows to be able to then reclassify between operating and financing for the purposes of IFRS 18. To give you a sense of how that would look, I've done the calcs, very, very rough back of the envelope calcs, but they're calcs nevertheless. So year 1, we worked out that the present value of the payable in 3 years' time is 32,876. And I've shown over the estimated 3 years there that the top, in the top table, part of the table, you can see that I'm on the opening. Now, key thing to this too is remember it's different from the first example or previous examples. There's no repayments until the last period. And that can make a big difference to your interest expense and also can have implications for whether or not it's material or not. So keep that in mind, is that when you obviously repay something back over time, it can diminish the interest, well, it can minimise the interest payments or the interest expense recognised. But if you've got a one bullet payment at the end, you would expect that your interest will increase over time towards the payment date, and that might mean that sometimes your interest goes from maybe being immaterial to actually material. And so as a consequence, you need to think about this going long term. If you are doing certain things now under IFRS 18 because of materiality, they may change over time as a consequence of the way the numbers sort of pan out. Anyway, so the provision, so we recognise the provision, debit the right of use asset, credit the provision, I recognise it for the 32 grand. Now I start unwinding the provision. So first to recognise there, the 4931 is the interest for the first period, provision. Now I get to the second year. My question was, hang on, what's happened? Well, what's happened is I've changed my interest rate from 15 to 18%. So when I increase the interest rate, what that actually does is decrease the provision. And so as a consequence, if you look under, it's effectively the time, it's the second number under the opening column at the top of the table, 37,807. If I then recalc it to 18%, I get 35,909. So the difference between those two numbers gives me that 1898 number, the provision, the interest income. So you can see that my opening in provision was 37,000, but as a consequence of changing the discount rate, it's now 35,000. So I have to recognise that as an interest. I might call it interest income. I might call it remeasurement of provision. Either way, it is a specified income item, and so therefore it goes into the financing category. Then I start to unwind again. Now, in year 3, this is the tricky one. So It's starting there with on the right-hand side, the journal starting at debit provision expense, credit provision. In this case, because I have got an adjustment to my expected cash flows, that provision expense is going to my operating category because it's an adjustment for the cash flows. So if you look at the calculations under the title year 3, 16% plus change in cash flows, what I've done is split out the effect of the cash flow changes from the effect of the financing features. And so the cash flow changes, the 8475, is effectively going from the closing at the end of year 2, which was 42,373 to the 50,847. And that's what gives me the difference, the 8475. Now I start to unwrite. I need to then work out what my interest adjustment is, which is the 877 there in the journal entry. So that's really the difference between the 50,847 and the 51,724 in that bottom table, the two opening balances. And then I unwind at the 8276 to get to my 60,000 and then zero. So very complicated. Provisions can be very complicated. This one's probably more complicated than you normally see because there's changes of interest and cash flow changes. But in principle, this is what you need to do under IFRS 18 to basically be able to break out the various components and reclassify them in a way that are consistent with the requirements. I provided this before, but this is a good little practice aid that we've published in our BDO Global publication, which covers off on the way you deal with different types of liability. So reclassifying between those that are purely type 1, purely financing, from those that are both a combination of financing and non-financing. So takeaways, quickly, how are we going for time? I'm going to be pushing it a bit from this point in time, but anyway. The key takeaways, again, I'll reiterate, there is an assumption underlying these takeaways, particularly the first two listed on this side, that your current chart of accounts gives you visibility to all of the income and expense items that you're going to have to separately identify and classify to financing activities separately from the other categories. So if you don't meet this assumption, that's work you need to do to basically get you yourself to that point. But if you are at that point, let's assume for the sake of the argument you are at that point, the next step is you need to distinguish your type 1 and type 2 liabilities. You need to identify the income and expense items linked to those type 1 liabilities separately from the type 2. You need to tag or reclassify specified income and expense item accounts to the financing category, and assuming that everything else drops into operating, if that's how it works. And critically, again, formally document what you've done, so particularly assumptions, analysis, and policy decisions. To that end, one thing I would also say is that, and it goes back to the sort of discussion about materiality, I mean, everything is obviously subject to materiality, and whether or not you put interest expense in maybe operating or financing might be a materiality question. But a key thing to remember is that the quantum of interest expense can change over time as the balance of your liability changes. And so as a consequence, you need to just be wary that what may be possibly immaterial today can become material in the future. And we often see this with lease liabilities, where, for example, if you're given, for example, you recognise a lease liability and you've got a rent-free period at the start of the lease agreement, that can give rise to quite significant interest expense in the first, for the first period, especially over the rent-free period, because you're not paying down the lease liability. So as a consequence, it's compounding on compounding on compounding. And as a consequence, you will find that your interest expense will grow quite quickly. In that situation, you might look at it and say, well, the rate is not large. Why is this material? It's because it's compounding on top of compounding. So it's not just a case of what the actual quantum of the rate is. You need to think very carefully about what's the period of time I'm talking about, and what's the balance on which it's this interest rate's being applied to. What's the size of this balance? Because that's really going to determine and what actually your interest expense looks like. So operating category, I'm not going to dwell too much on this one because it is really quite the residual one, but it sits there within the operating category. It's everything that's not classified elsewhere into your P&L. And so it picks up things like revenue from contracts with customers, and if you're an insurer, maybe insurance revenue, credit losses on trade receivables, inventories, depreciation, impairment gains and losses on assets that don't generate income independently of others. So it's all of the things that you'd normally expect to see in an operating sort of category. Again, our BDO publication provides a good sort of some extra lists of sort of things you expect to see. I think the important part I wanted to take away from that slide is, though, that when you look at in that second half of the bottom half of the slide, the first red arrow dot point, it talks about income and expenses related to liabilities that arise from transactions that do not involve only the raising of finance, that are not interest income and expenses, or interest expenses and income arising from changes in interest rates. So we went through an example just now with that regarding provisions. And so the expenses related to the consumption of goods and services of which the liability is recognised. So the idea that the cash, the change in the estimated cash flows, they are caught in operating. Now, again, I suppose to reiterate just the importance of not everything is going to be caught in financing and in the financing category, for particularly for liabilities that arise from transactions that involve not only the provision of finance, that there's going to be a component that has to go to operating. You need to be able to componentize that change and reclassify it appropriately under IFRS 18. I think a lot of entities probably up to this point in time, if you had material provisions, you're probably just doing it from year to year. And there wasn't probably a great deal of work around the components of the change. It was just simply the opening and closing balances, and what was the differences just going straight to P&L. So it's those kind of items that are going to probably pose the biggest challenge to entities when they're trying to apply IFRS 18. Let's just have a quick look at categorisation of other income and expense items. I know I'm going a little bit late, but I think this one's actually quite important. So I want to sort of spend maybe 5-10 minutes on this. IFRS 18 has specific requirements applicable to the items listed in this slide. So to foreign exchange gains and losses, income and expenses from derivatives, and income and expenses from hybrid contracts with host liabilities. In principle, what IFRS 18 requires from these ones is that the income and expenses their classification follows whatever the underlying classification is. So, for example, and you can see it in the slide, the first pictorial there for foreign exchange gains and losses. The requirement to classify foreign exchange gains and losses in the same category as the associated income and expense. So, e.g., foreign exchange on trade receivables in the operating category. So, movements in the trade receivables would be recognised in the operating category, and so therefore foreign exchange related to those trade receivables will be recognised in the operating category. So, these are the principles. But I wanted to sort of highlight some of the challenges that these principles will pose for a lot of entities in trying to apply them in practice. So first thing, Forex principle. So if we just focus on the foreign exchange again, I mentioned before, foreign exchange gains and losses included in the profit and loss applying IAS 21 are classified in the same category as the income and expense items from the items that give rise to the foreign exchange differences. So unless doing so would involve undue cost or effort. So what are we talking about? So I mentioned before, trade receivables. So if you've got a trade receivable denominated in foreign currency, and let's just assume that's all you have, you've sold to somebody overseas, you're going to classify the related foreign exchange gain or loss in the operating category. All right? Liabilities involve only the raising of finance. So remember, I'm not dealing here with specified main business activities in this presentation. Just ignore that for the time being. I'm going to classify the related foreign exchange gain or loss in the financing category. Okay. Now, the practical considerations. So if I'm classifying foreign exchange gains and losses related to income and expense items in more than one category, such as, so remember I've just mentioned before, so those liabilities that are not just financing, but there's a service element in them as well. So lease liabilities with, say, modification gains and losses. So a lease liability, the interest would normally be recognised in financing, but if you modify the lease and have to remeasure the lease liability, the gains and losses on that remeasurement are actually recognised in operating. But if the lease itself is entirely denominated in foreign currency, then you've got to think about how am I going to allocate the foreign currency between those two components. And also trade payables with extended credit terms. So imagine you've got a payable overseas, but for some reason the person who sold you the goods has said, look, it's all right, you don't need to pay me for 6 months. And if that's the case, then you've got a multiple of things going on there. You've got credit being extended to you, and you've also got the foreign exchange feature. Okay, so there's a service element that relates to the trade payable, but there's also a credit element, so a financing element that relates to the credit terms. And so as a consequence, how do we manage, or how do we allocate the gains and losses, the foreign exchange gains and losses between the operating and the financing category? And the standard says exercise judgment to determine how to classify foreign exchange gains and losses across those operating financing categories. So you need to think through, and this is, we included this in the BDO Global publication. I mean, there are probably a couple of ways of doing it. One way might be to identify what's the main driver of the expense. So for instance, for leasing, you might say the main driver is financing, whereas for, say, an employee benefits, you might say that the main driver is service. And so that'll tell you where maybe most or all of the foreign exchange gains and losses go. And also question the duration of the liability. So you would imagine the longer the term, it's more likely finance driven. And therefore you classify more, if not all of it, into the finance category. Other areas of interpretation, I'm not going to go into detail here, but just want to highlight them. Foreign exchange gains and losses on intercompany loans. So when you do consolidation of intercompany, companies that have intercompany loans, typically what you get is a gain or loss related to those intercompany loans if they are cross currencies. And so the question has been asked, what do you do with that? Where does it go? The IFRIC have considered it, and IFRIC were perfectly split down the middle as to whether it goes to operating or somewhere else. So again, the standard's silent on it, and so it's something you'd need to consider, and again, subject to probably something that would be make a marvellous subject of an accounting policy paper. Gains or losses arising from net monetary position under IAS 29, so if you're doing hyperinflationary accounting. And what is undue cost or effort? Like how far do we go? How much work does this involve? And what's the sort of criteria? What's the hurdle over which we wouldn't jump to do certain things? Again, it's judgmental, and so you need to sort of think about that in terms of, and documenting that in terms of your accounting policy going forward. Hedge accounting. I just want to talk broadly about the use of derivatives. And it's interesting, what IFRS 18 does is it introduces almost a new category of hedging, but not quite hedging, in the sense that it allows you to, and it requires you to, classify certain gains and losses on derivatives in a way that might look a little bit like hedging, but it's not actually hedging. But it's an interesting sort of half house at this point in time. So broadly, derivative contracts, you can use them to manage either both reporting risk or economic risks, and you might do it for things like interest rate risks. So you might use interest rate swaps that swap fixed interest payments for variable interest, or vice versa. Foreign currency risks, you might use foreign currency forward contracts or options to buy or sell foreign currency at a future date at a fixed exchange rate, or you might do it for other price risks. So for example, if you hold marketable investments that you need to either buy or sell in the future, you might use options to buy or sell to mitigate those risks. It's important to remember the way in which entities use derivatives to manage these risks can range from applying hedge accounting, which I've described there on the left-hand side of this slide, to actually actively managing the volumes to provide a natural hedge, or just simply holding the assets, assuming they're going to be a benefit to you at some point. And this actually covered all three. So we look at designated hedging instruments. Yep, we've got fair value hedges, cash flow hedges, or hedging of a net investment. Now, under IFRS 18, the effective portion, or under IFRS 9, the effective portion was recognised in OCI until the risk being hedged is recognised in the profit loss. Now, when you move to IFRS 18, that actually confirms that gain or loss is deferred in OCI. When it's classified back into operating, it's classified in the same category as the income and expense affected by the risk. So, for example, if you've got you're hedging foreign trade receivables, then you'd expect that the gains and losses on the derivatives, when they're brought back to the P&L, will be recognised in the operating category. The ineffective portion will actually follow the effective portion. So typically sometimes you have an ineffective portion on your derivatives, and you recognise that in P&L, and you do that against wherever likely is that the effective portion is going to be reclassified to. So typically with those, so for example, trade receivables. If you are hedging trade receivables overseas, you'd expect that therefore both the effective and ineffective portions of the movements on the derivatives, the hedging instruments, would be recognised in the operating category. Moving on, and this is the new category that IFRS 18 sort of identifies. If you use derivatives to manage identified risks, now, if derivatives are not designated as hedging instruments, but you use them to manage identified risks, such as interest rate risk, foreign currency, other price risk, if you do that, then there is the requirements under IFRS 18 that the gains and losses be classified in the same category as the income and expenses affected by the risk, subject to not grossing up of the gains or losses. I can't go into detail here on that because I'm running out of time, but let's suffice to say that if you hedged net positions and those net positions involve two items that were in different categories for the purpose of IFRS 18, you can't gross up the hedging gains and losses and split them across the category to get your right P&L number. If you have to gross up, then it all has to go to operating. So it's unusual, but it's not that unusual. Often see entities, what they might do is they might have overseas receivables, and they've got a loan overseas as well. So they might naturally hedge the overseas receivables against the interest expense. But then what they do is they might then hedge the net position. Now, if you're doing that, you're going to probably have to gross up, in which case you're not going to be able to do that. You're going to have to recognise those in the gain. So the general principle of the gains and losses following the risks will not apply here. They'll go straight to operating, or otherwise will not involve undue cost or effort. Last category is just where you just simply hold them. And again, if you hold them for no other reason than just simply for protection, then effectively they're going to go into operating because they don't have a risk necessarily that they're chasing. Now, our BDO Global's provided a really good summary of that. It's starting to look more complicated, I know, but it is actually quite a good summary description of that. A good decision tool to apply when you're looking at this situation. But it does give that very clear distinction between, at the very top, the questions asked, the threshold question, is the derivative being used to manage identified risk? And if the answer is yes, then your question is, are you in hedge accounting or not? If no, then you're going to have to start to work through it. Now, there's a couple of references in there to specified main business activities, so I haven't covered those in this, but you can see now that when you add specified main business activities, it adds another level to the discussion and to the decision making that you need to sort of be aware of. And I'll cover those in a later webinar. The last one I wanted to cover was the hybrid contracts, because often people don't see these many, if at all. Hybrid contracts we typically see in the form of financing agreements that include like a host debt contract, which is like a debenture or a bond, with an embedded conversion feature that permits the holder to convert the note into ordinary shares of the issuer of the hybrid contract. Now, this feature is usually included as a protective feature. So if something goes wrong with the bond, the holder of the bond can perhaps convert them into shares, and then they have some decision-making power over the issuer, or that they have some influence over the issuer and what they do. Or they might also be included because of value, because the holder might sort of think, look, if I give them this money now, the value of this company is going to go up. So it might be a good opportunity for me to spread my risks, and actually, rather than just take interest, I'm going to have an exposure to their equity. So hybrid contracts, and I suppose the third thing I was going to mention here, the key part is that both the host and the conversion feature are classifiable as financial liabilities. Therefore, the question arises, what income expenses arising from these instruments are classified in financing and operating? This classification process can be made easier or actually more complicated by the prospect that the embedded derivative may or may not be separately accounted for. So you might actually find that the derivative is not on the balance sheet. And that could be because of a number of reasons. It could be because the derivative is not considered to be a derivative within the scope of 9. So it might be because it's a part of an executory contract where you're expecting to take whatever the corresponding amount is. So the liability might be a supply agreement, or the embedded derivative is it's not distinct. The risks are not distinct from the risks of the underlying instrument. So in fact, it's all just sort of one part of one whole instrument. I won't go into too much detail on that, but yeah, they do exist. And I've given a couple of examples there. So convertible note, so you've got a host debt instrument with an option to convert into a variable number of shares, which makes it a liability. Also, potentially lease liabilities where, and we don't see a lot of them in Australia, but they do exist, where periodic payments might be tied to an index of some kind, like an S&P 200 index, or not a CPI, but to some other index that moves with, say, share prices or something similar. And I mentioned they're subject to complex requirements. I mentioned the idea that the own use exemption, so maybe they're not within the scope of 9, or that you actually don't separately account for the embedded derivative. Now, in summary, general requirements in IFRS 18 apply in classifying income and expenses relating to hybrid contracts. First, you have to make a decision about whether the instrument is a type 1 or a type 2 liability. So has it been issued entirely for financing reasons, or does it have both a component of financing and operating in it? So financing and servicing. So like a supply agreement with an embedded derivative within it. So if it's a type 1 liability, then your specified income and expenses generally go to the financing category. When it's type 2, you're going to have to split it between operating and financing. Now, if the embedded derivative is accounted for separately, then you've got to you're effectively your type 1, type 2 classification will drive then that treatment. So if it's separately accounted for, you say to it, okay, is it, you work it out to apply the requirements applicable to gains and losses on derivatives. So is the actual embedded derivative used for a hedge instrument or not? Or is it held to mitigate certain risks? If that's the case, then you've got the accounting applies. Otherwise, it goes into operating. if no, if it's not separately accounted for, then every movement in the embedded derivative is really caught up in the underlying instrument. So you don't really have to worry about separating out the gain losses on the embedded derivative to work out where they go, because it's not accounted for separately. Again, BDO has provided I think, quite a good little practice aid to sort of get your head around what you need to do. But again, you can see that the complexity in this situation sort of arises once you start building out what the components of the particular underlying asset or liability is, and how the different parts of it are going to be treated and classified. Takeaways, very similar. Again, I'll reiterate my previous comments. If your system is sufficient to carve out the individual items that you've got direct visibility to the components of these movements, the incomes and expense items, all good. If you don't, that's probably something you're going to need to think about to get yourself into IFRS 18. But if your system does do that, that's all good. Then you are going to basically have to work out, do I have foreign exchange, derivatives, and hybrid contracts? I've got to identify all income and expense items linked to those items. Then I've got to classify those items subject to the requirements in IFRS 18. I've also got to tag them for the purpose of making sure that when I prepare my financial statements, they go to the right section within the P&L statement. And finally document what you've done, particularly around assumptions, analyses, and policy decisions, if available. That brings us to the end. I hope I've covered off everything. I just wanted to mention, when I say, do you need assistance, I'm probably thinking, there's a lot of people probably thinking right now, I probably need to lie down at this stage on the basis of that. But if you do need assistance, obviously, I mentioned before, our BDO publication is available. It's a very good one. It's got lots of great little practice aids and good explanations, great pictures that actually help to explain what you're doing. Our IFRS and corporate reporting insights, a lot of the material I've taken from them, and I do actually feed material back into those articles. So next month's article will probably include some discussion on what we've covered today, to give sort of to really close the circle around what we've actually talked about and the kind of issues. So both of those are available for you to access or actually subscribe to. I mentioned before the masterclass. If anything in this presentation has caused you concern, then I would recommend that you subscribe and join us at the masterclass in the next couple of weeks. So on the 27th of March, we're going to be looking at transitioning a profit or loss to IFRS 18. So I'm going to be talking about all of these kinds of things. I'm actually going to be working through a practical example, and again, underlying the practical examples, the assumption that you can visually see all of these components, but obviously that's another part of work involved in IFRS 18. But in understanding what you need to do, I suppose the first step is actually being able to sort of work through an example and work and seeing how these requirements work, and that'd be a good opportunity if that's something that you feel like you might benefit from. So I'd certainly recommend anyone, if you are curious about or need assistance, that's a good place to start, is our IFRS masterclasses. I've mentioned before our corporate reporting insights, obviously mentioning our education and learning. We've got IFRS 18 materials, which I mentioned before, so they're available. There's also an IFRS 18 course that covers a lot of the materials we've covered today, but a good way to reinforce what I've talked about today. You can access our IFRS and corporate reporting experts directly if you want to, obviously contacting myself or any of the other IFRS and corporate reporting partners within the BDO network around Australia. The BDO lease management services and lease dashboards, we do provide quite extensive services to entities around managing lease accounting and managing leases itself through the dashboard. Fahad is working really hard to engage with clients on this and explaining to them what the dashboard does for them. It's a neat little bit of technology, which I think if you currently have access to, or you're receiving lease management services from BDO, is something that's worthwhile looking at, and I would suggest that you contact Fahad and see if you could set up a discussion with him on that topic, because I think it would be something that would benefit entities a lot. Our IFRS and corporate reporting partners right around the thing, so around Australia. So if you have an issue or that you would like to discuss the implication of, say, for example, IFRS 18 or any other accounting standards, the contact details are available. Just want to mention sustainability reporting. Obviously, we are still working through our sustainability. Everyone's still working through the sustainability reports. We have 4 sustainability reporting specialists that you can contact and speak to. So it's a letter, obviously, here in the Melbourne office, Kevin in Sydney, Tom in Brisbane, and Ashley in Perth. that takes us to the end of the presentation today. I hope you got something really useful from it. Like I said, there's a lot to work through on IFRS 18, and I think it's a really good example of, with lots of transition to accounting standards, about clear thinking. So understanding exactly what it is you need to be able to identify, then working your way through to actually identifying it, classifying it, and working out how you're going to actually apply the standard in a way that actually does make sense to users, and is consistent with what your users sort of expect to see. So other than that, enjoy the rest of your week, and I'll speak to you soon.